So Trump just announced sweeping new tariffs. 10% blanket tariff on every country and every import into the US, plus additional tariffs on every country based on what Trump perceives as their base tariff rate or their abuse rate of America. In some cases, this is as high as 54% on China. The market reacted pretty swiftly, plunging over the past few days and wiping out more than $5 trillion of value from the US. So why such a drastic response? Let's try and understand what the tariffs mean, when tariffs work and why we use them, and why these ones are fundamentally different in a way that's scaring the market. Unlike previous targeted tariffs, Trump is applying a baseline 10% tariff to every single good, and then an additional baseline tariff on each country, ranging from 20 to 50%. These layered on tariffs are supposedly based on the trade imbalances and trade deficit that the US has with that country. Trump argues that when a trade balance is negative, it's a country ripping us off, and we need to manage that trade relationship. The problem is that Trump's logic, or lack thereof, is a basic misunderstanding of how trade imbalances and trade balances work in the first place. Trade deficits aren't an inherently negative thing. They reflect the patterns of investment and consumption from another country, and they often reflect the differences in the economic makeup of those countries between producers and consumers. Let's give an oversimplified example. Let's say you're a local grocery store. You go in and buy groceries. You spend $100 on groceries, they give you food. Technically, your trade balance with the grocery store is now negative $100, even though they gave you $100 worth of produce. You received goods equal to your spending. That's not being ripped off. That's shopping. Just because you don't have anything to sell the grocery store that they need doesn't mean that you didn't get the value for your money. And that's why there's a fundamental misunderstanding here. Trump and the economic advisors in his circle view this as a negative thing. They view it as something where America should produce every single thing it consumes, and that's simply not feasible. So what can we expect as the consumer impact here? First off, these tariffs are expected to go into play April 9th. And the reality is that the market isn't fully pricing in the potential pain here, because so far in the Trump administration, there's been a lot of flip-flopping on policy. We don't know one day to the next what policy is going to stay, and these tariffs are no different. So the market is still cautiously walking along, not fully pricing this in hopes that either countries negotiate as Trump has wanted, or that the Trump administration backs down on this idea. As we get closer to that April 9th date, markets are going to continue to price that more efficiently. And if this stays, that means more pain for the markets at large. But what about consumers? Should they expect that on April 9th prices are going to go up? Whenever we see tariffs, we see different types of reactions. Certain industries where raw materials are brought into the US for manufacturing may have a short-term advantage here. They'll often bulk buy, pull forward, using all their cash flows, all their lending abilities to buy their raw materials, bring them into the United States, and have a set amount of runway before they have to raise prices. Their goal is to capture more market share. That means in certain businesses where they're selling raw materials, you might see actually surprisingly strong quarterly results because of that pull forward. Those companies that are doing the producing might have a few months of runway before they actually have to start passing on the full price to the consumer. They're betting on the situation where the tariffs are so bad economically that the damage to the market and the damage to international trade brings parties back to the negotiating table to remove the tariffs before they actually have to pass on those costs. Some companies that rely on overseas manufacturing, overseas shipping, or just-in-time manufacturing and delivery will likely have to put up their prices right away. Other companies with large inventories, major box stores, grocery stores, furniture stores, things like that, might have 3 to 6 months of inventory runway before they actually have to pass on prices to the consumer. So in this case, they're likely going to continue to reevaluate their margin and their pricing and their new sourcing before that passes on. So there's likely a lag time. This lag time could be dangerous for the markets where people are feeling a relief that maybe these tariffs aren't going to be as bad as they thought before the final impact hits. But when we talk about the actual tariffs hitting the consumer, we can expect that over time, if that 10% base tariff stays, you're looking at a 20% plus compounding cost effect on anything that has supply chains involving international goods, which is most stuff in America. And if these larger tariffs stay, including the 54% on Chinese goods, that's going to get a lot worse real quick. And we'll expect discretionary spending to drop. That would be our first major red flag that we're looking at not just a mild recession, but a larger depression potentially, possibly spiraling out into what we call a lost decade. If consumer discretionary spending begins to decline at a time when credit card debt loads and household debt loads are at an all-time high and consumer savings are at an all-time low, we're headed for disaster, especially when we see GDP growth slowing as well. But the reality is that we don't know how this is going to play out because there's still a lot of time for Trump to change his mind before the policy. There's still the potential that the market damage and the economic damage becomes so bad that members of his cabinet or members of his Senate begin to turn, putting pressure on a policy change, or the very unlikely possibility that many of the major countries such as China and the EU come to the negotiating table and agree to drop all tariffs. So if this doesn't change, what are the key catalysts we want to watch out for? Well, first, one we're in already, this April 5th to April 9th. April 5th is when the 10% tariffs went live on every single country. April 9th is when these extended retaliatory tariffs are expected to go live. As we get closer to that April 9th date, the market is going to more efficiently begin to price that in. If there hasn't been a policy change, bounces in the market on technical levels probably are a trap that we want to avoid. It's okay to not take a position in the markets while waiting for something to resolve. If we get past that April 9th date, we're going to begin to now look at what retaliatory tariffs can we expect. A few countries have announced immediate tit-for-tat tariffs, but it's likely once the economic impact of these tariffs begins to get felt, once this is a reality that is implemented, more countries, including the ones that have already done it, are going to have much more robust retaliatory tariffs of their own applied back onto America. Then the next key catalyst for the market is going to be those Q2 2025 earnings. That's going to be in July and August. Those corporate earnings reports are going to allow us to better understand the real impact of these tariffs if they stay long term, because we're going to begin to see from companies how they expect it to hit their bottom line, squeeze their margin, change their sourcing, and change their overall sales to customers. It's at that time that the market will begin to most efficiently price likely fair value of stocks at that time is. Now, Trump proponents are saying that this is a purposeful play. This is a way to improve manufacturing, bring it back onshore, crash the economy to refinance cheaper debt, and I'll have videos specifically diving into each one of those. But let's talk about one of the more important ones at a high level. This idea of refinancing the US debt because bond rates are coming down is a fundamental misunderstanding of how rates work. There's a big difference between the prime rate and the ask yield rate on a bond. The government doesn't issue debt in the way that you take out a mortgage. There is no opportunity to bulk refinance everything at a lower price. And the reality is that the government has a pretty low average interest rate right now on its debt. The problem is that the debt is just really large. Because the current average interest rate of the US debt is only 3.36, just because the 10-year falls under 4% on the ask yield doesn't mean that we're going to be able to refinance much. This is compounded by the fact that a lot of the US debt isn't at that short term. There's only $3 trillion of short-term debt coming up to maturity that isn't already coming down at a lower rate. Lower yield rates reflect fear. They do not represent an opportunity for America to get a better deal on debt. And that market volatility is going to overall reduce consumer confidence, including in this time in the full faith and credit of the US government, which could spell disaster for our debt, and is something we actively want to avoid. So how do we navigate these tariffs if they stay? Once again, going to dive in specific videos throughout the channel over the coming days because these are complex topics. But at a high level, there's a few scenarios. If the tariffs stay, we're probably going to want to diversify our portfolio away from anything that's rate sensitive. Retail, auto, electronics, things like that. We're going to want to look for things that are great inflation hedges, commodities, tips, and if we've really bottomed out already, then maybe things like real estate. If there are partial rollbacks of those tariffs, some consumer discretionary that's been hit overly hard represents a great bounce back opportunity. What you're really going to want to look for is those opportunities in Southeast Asia, such as we're seeing with Nike and Vietnam. And if global retaliation escalates in late April, early May, as we expect as a possibility, then it's time for defensive positioning. Cash reserves, utilities, consumer staples on the low end, healthcare stocks, bond funds, perhaps even looking at foreign bonds and foreign sovereign currency. Your goal here is just to hedge against a prolonged downturn. Wait until the economic reality of those Q2 earnings come in to really understand where to move next and protect your cash at all opportunities. At the end of the day, Trump's tariff strategy isn't just a policy shift. It's an economic gamble with basically no winners. It's based on flawed logic, and right now we're playing a game of economic chicken. The reality is, because it's based on self-inflicted policy, we can't use normal market indicators here to decide when it's time to buy, or to game out what strategies we should be implementing in order to survive this moment. All you can do as an investor right now is understand the underlying economics, the potential outcomes, and have a plan ready for each outcome state, and continue to monitor closely. Over the coming days, I'm going to have more videos diving into each of these topics in depth, as well as where I'm looking in each strategy case to build a portfolio based on potential outcomes. So make sure to like and subscribe if that's helpful to you.